Welcome back, everyone. I'm Kirill Talai, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. 3 stories today. Number 1, first quarter results from the 4 hyperscalers, the companies spending the most on AI infrastructure. For 2 quarters, the market has been asking the same question. Is the AI Capex actually generating revenue? Or is the money disappearing into a black hole? The Q1 numbers answered it. Second, 2 AI bottlenecks. The White House just used the 1950 Wartime law to fast-track the US energy grid. The same statute they used for COVID vaccines and Korean War weapons production. And Intel's results confirm the CPU bottleneck we covered a few episodes back. And third, crypto. The Clarity Act, the bill that would lock US crypto regulation into law, just broke out of months of Senate banking deadlock. The holdup was a fight between US banks and stablecoin issuers. Bitcoin is back near 80,000 on this year's. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Quick Iran update before we get into the stories. Probably everyone is already tired of all the headlines, but I need to do one. Oil is still slightly above $100. The situation is still challenging. But the US administration just tried something new. On Monday, US Central Command launched what they're calling Project Freedom. It is not a formal escort mission. It is closer to coordination. 2 US flagships transited the strait that day. Iran did not stand down and tried to attack with small boats and missiles. US hit all Iranian small boats. The tankers eventually got through. My read is that Washington understands the clock is ticking. Oil at $100 going into midterms is a political problem. The US has framed Project Freedom as a humanitarian operation, protecting multi-flag civilian shipping through Hormuz. The bet is that Iran cannot afford the global PR cost of attacking traffic from many different countries that has been publicly labeled humanitarian. So far, the bet is holding, but a bigger Iranian response, mining or a missile strike on a tanker, is still on the table. For the record, I still have the same view that any pullback on escalation should be bought. Let's start with the hyperscalers. On April 29th, all 4 major hyperscalers reported Q1 results on the same night. Microsoft, Google, Meta, and Amazon. The 4 companies spending the most on AI infrastructure. The whole AI Capex story was on trial that night. The market has been skeptical of this trade since late summer 2025, and the doubt has not fully gone away. 2 questions have been hanging off the trade for months. First, are these massive Capex programs actually generating revenue? Or is the money disappearing into a black hole? Second, are they done spending? Or is more coming? The Q1 prints answer both. Let me start with the question that mattered most. Are they making money on AI spending? The cloud business is where most of the AI revenue shows up. Hyperscalers spend the AI Capex on data centers and chips, then ran that computer back to enterprises and AI labs through Google Cloud, AWS, and Azure. So, if the AI Capex is generating revenue, you will see it in cloud growth and cloud margins. If not, the cloud numbers will be weak despite the massive spend. Google's answer is the cleanest. Their cloud operating margin went from 18% a year ago to 33% this quarter. It nearly doubled. On revenue that grew 63% year over year, crossing $20 billion in a single quarter for the first time. And the cloud backlog, the amount of contracted but unbilled cloud business, jumped to $462 billion. That number nearly doubled sequentially in 1 quarter. The bear case on Hyperscalers' AI Capex has been that AI services would be lower margin than legacy cloud, that the spend would compress returns. Google just showed the opposite. AI revenue is not dilutive to cloud margins, it's accretive. And demand is running well ahead of what they can ship. Google CEO said on the call, "We're compute constrained in the near term. Our cloud revenue would have been higher if we had been able to meet demand. They cannot ship enough compute to meet what customers are willing to buy. That is pricing power." AWS, Amazon's cloud business, tells the same story. AWS revenue grew 28% year over year. That is the fastest growth in 15 quarters. Cloud revenue re-accelerated, and the run rate is now $150 billion annualized, with $364 billion backlog on top of that. So, on the first question, are they making money on this? The answer is yes. This is the first quarter that actually proves it, and the repricing higher is in early innings. Now, the second question, are they done spending or is more coming? 2 of the 4 raised their 2026 Capex guidance versus what they have told the market in February. Google raised by $5 billion. Meta raised the midpoint by another $10 billion to a range of $125 to $145 billion. Microsoft held at around $190. Amazon held at $200 billion. Add them up and you're roughly at $700 billion in 2026 Capex from these 4 companies alone. 3 months ago, at the Q4 2025 calls in February, the combined number was around $685 billion. Google and Meta have raised again, adding another $15 billion. And 2026 is roughly 70% above what they spent in 2025. The driver behind the Capex inflation is memory. Amazon's CEO said it most directly. The cost of components, particularly memory, has skyrocketed. Microsoft CFO put a number on it. $25 billion of the $190 billion Capex is from higher component pricing. Memory prices are not normalizing, they're accelerating. And it does not stop in 2026. Google CFO said on the call that 2027 Capex will significantly increase compared to 2026. No number yet, but the direction is locked and clear. Meta's CFO said the same thing differently. We continue to underestimate our compute needs, even as we have been ramping capacity significantly. Now, the stock reaction. The market rewarded the names that showed AI revenue growth and punished the ones that did not. Google traded up about 10% in the 5 days since the print. Amazon was up too, but more modestly, carried by the 15-quarter high on AWS growth. Microsoft was roughly flat. The print was solid, but supply constraints are throttling near-term revenue. Meta dropped almost 9% the day after. The Q1 print was weak on the AI revenue side, and they raised the 2026 Capex guidance on top of that. But the biggest story is who is on the receiving end of all this money being spent. The 4 hyperscalers are at close to $700 billion in 2026, heading toward $1 trillion in 2027, and the build-out runs into 2030s. We have been pointing at this trade for a while. The picks and shovels of the AI Capex, the chips, the memory, the power equipment. The receivers are already booming. Go have a look at our previous episodes for more investment ideas. Now to the supply side. On April 20, the White House did something that did not get enough attention. They invoked Section 303 of Defense Production Act on the US energy infrastructure. Let me explain what that means. The Defense Production Act is a 1950s law from the Korean War. Section 303 specifically gives the president direct authority to subsidize, fast-track, and pre-purchase strategic industrial output, with the national defense label as the legal mechanism. It has been used for COVID vaccines, medical supplies during shortages. It is a real tool with real money behind it. The president signed not one, but a stack of Section 303 determinations, covering grid and large-scale energy infrastructure, coal supply and baseload power, natural gas and LNG, domestic petroleum, the entire energy stack treated as national defense infrastructure. On the grid determination, the language is unusually direct. United States industry cannot reasonably be expected to provide these capabilities in a timely manner due to limited domestic production capacity, extended procurement timelines, foreign supply dependence, and insufficient capital investment. That is the US government on the record admitting that the domestic industrial base cannot deliver the energy infrastructure the country needs. The coal determination goes even further. It explicitly cites AI as a justification. So, put it together. Energy is the bottleneck for the AI build-out. The market knew. The corporates have been saying it for several quarters. Now the White House is acting on it. That is a meaningful signal of where the next several years of policy go. Now to the corporate side of another bottleneck. Intel reported Q1 earnings in late April. The numbers are striking. Revenue beat by $1.4 billion of the midpoint of guidance. EPS came in at 29 cents. This is a guide of break-even. The data center segment grew 22% year-over-year. The custom ASIC business inside data centers is now at over $1 billion run rate. But the most quotable line of the call came from CFO. An analyst asked how much revenue Intel is leaving on the table because they cannot ship enough product. CFO said, I probably do not want to put a specific number on it, but let's just say it starts with the B. So it is meaningful. Starts with the B. It starts with the letter B, as in billions a quarter that Intel cannot ship. He will not put a specific number on it for competitive reasons, but the order of magnitude is meaningful. Demand massively exceeds supply. We talked about compute needs for training AI models and for inference. Inference needs more CPUs that Intel produces. CEO said on the call, the ratio of CPU to GPU used to be 1:8. That was the training era. And now it is 1:4. That is the inference era. And I think it could move towards parity or even better. That is the agentic era. As workloads shift from training to inference and from inference to agentic, the CPU intensity per rack goes up materially. Every dollar of incremental AI spend is becoming more CPU favored. That is why Intel's server CPU addressable market was revised from flat and the prior earnings call to up double-digit units now, with momentum into 2027. Intel stock is around $110 now, up from $25 in September, roughly 4.5 times in 8 months. We flagged Intel back in episode 7 when we walked through the AI chip value chain and the strategic stakes the US government had taken in the company. The Q1 print confirmed the thesis. Now, I want you to think about this. We're only about 4 months into the agentic economy. Late 2025 is when Cloud Code went mainstream and the agentic workload curves started accelerating. The constraint is already this tight now, just 4 months in. What does it look like at 12 months, at 24 months? The companies, the government, and the market are all converging on the same answer. The AI build-out is going to absorb every available unit of compute, power, and grid equipment for years. Now to crypto. It has been a few episodes since we touched the regulatory side. A bit of context first. The Clarity Act, formerly the Digital Asset Market Clarity Act of 2025, is the structural piece of crypto regulation in the United States. In plain English, it does 2 main things. It defines which agency, the SEC or the CFTC, regulates which type of crypto asset. and it codifies market structure rules. The same kind of rulebook that exists for stock market, but written for digital assets. The SEC under Chair Atkins has been releasing favorable case-by-case interpretations for months. And that has been very productive for the industry. But interpretations are reversible. A future SEC chair can undo them. The Clarity Act would lock the framework into law. That is the structural difference. But the bill has been stuck. And the place it has been stuck is the Senate Banking Committee. So let's talk about what was actually blocking it. The fight was over a stablecoin yield. Banks were worried about a specific scenario. If stablecoin issuers like Circle, like Coinbase, can pay holders interest the way bank deposits do, what stops customer deposits from flooding out of the banking system into stablecoins? That is depositor flight at scale. It would gut bank balance sheets and constrain the credit creation channel that the entire economy runs on. Crypto firms wanted the door kept open. Coinbase, for example, already runs USDC rewards programs that pay users for holding stablecoins. They did not want to give that up. Banks wanted the door slammed entirely. Two industries, two senators on the banking committee, two completely different views on what stablecoins are. And the bill sat there. The compromise landed on May 1st. Two simple rules. Number one, passive interest on stablecoin balances is banned. Anything that is, in the language of the bill, economically or functionally equivalent to a bank deposit is barred. That gives the banks that depositor flight protection. Number two, activity-based rewards are still allowed. Loyalty programs, transaction-linked incentives, programs that reward you for using stablecoins as payment. Those are permitted. That gives the crypto firms room to run their rewards programs. The framing in the bill is that stablecoins are payment tools, not yield instruments. Coinbase and Circle backed the deal immediately. The Senate Banking Committee could move to markup as soon as mid-May. The market is pricing this in real time. Polymarket runs a contract on whether the Clarity Act gets signed into law in 2026. On May 1st, the day the compromise was announced, the odds jumped 21 percentage points in 24 hours. They are now sitting in the mid-60s. Still, some risk priced in because markup is not a vote. But the trajectory has clearly turned. And Bitcoin is quietly grinding high in anticipation, now at around $80,000, up roughly 33% from the low 60s where it bottomed in February. The passing of the Clarity Act will give another boost to the crypto market. To wrap up, the Hyperscaler Q1 prints confirm the AI Capex trade. Margins are expanding. The 2026 spend is heading toward $700 billion. 2027 will be larger, and the receivers of this spend are already booming. On the supply side, the White House used the 1950s wartime law to fast-track the energy grid, and Intel's Q1 earnings report confirmed the CPU bottleneck. The build-out is going to absorb every available unit of compute, power, and grid equipment for years. And on crypto, the Clarity Act just broke out of the Senate banking deadlock. Bitcoin is around $80,000 and grading higher. Thanks for watching. If this was useful, subscribe and share, and I will see you next week.